ACC Aviation has conducted an analysis to understand how private aviation is financed. I'd like to introduce Naishal Chag, Senior Associate, to talk about the report and its findings. So, Naishal, considering the work that ACC Aviation Consultancy Division focuses on and the specialist services you provide, what was the primary catalyst that sparked the organisation's curiosity and encouraged you to research this report? Why is there a perceived lack of insight and transparency, and why does that matter?
Firstly, thank you for inviting me for this interview and asking me these important questions that needs to be addressed. Firstly, at ACC Aviation, we work around a spectrum of different aviation clients. Mostly we cater to commercial airlines, charters, financials, lessors. Now, we have a deep insight because of our field into why commercial airlines, how they are financed or how they are structured. But when it comes to private aviation, we don't have that insight. This industry moves millions and billions of dollars, but how they are financing and their growth is a mystery to us. And that is why it was important for us to kind of understand how they are financed. Secondly, there is a perceived lack because most of this private aviation industry is unlisted and private, so they do not release their financial information like commercial airlines do. Commercial airlines mostly are like highly regulated and they have the reports going on, but private aviation industry do not release these reports. So it was important to kind of bridge the gap between the financial knowledge that we can get from private aviation and understand how they're sourced and how they fund their growth, basically.
Thank you. So, in short, can you summarise the purpose of the report and what did you discover?
The purpose of the report was to basically demystify funding in the private aviation. So we wanted to kind of bridge the gap between how private aviation is funded and on how it can be sustainable. So what we identified early on is that the financing follows the business models. So we identified three business models majorly. They could be mutually exclusive or it could be interrelated. One was the operator-owned business model. Second one is fractional ownership, and the third one is aircraft management models. So in the first one, where the operator-owned model, in that model, what happens is the operator actually owns the aircraft and then provides access to its clients either through jet cards or through subscriptions or through charter processes. So the idea here with those operators is to actually take the responsibility of owning the aircraft and finance it themselves and not transfer the risk to your clients. And because they have to bear the risk of owning the aircraft, they need substantial funding to grow, and that's how they reach out to third-party providers, third-party debts. Second model is the fractional ownership model. Fractional ownership is basically where they kind of share the responsibility of the risk. So the customers would actually finance the aircraft and the fractional owners operators would kind of sell these shares to different customers. So basically transferring the risk to them. So now if you can see that as the customers are technically paying for the aircraft, the operators don't need financing to go through. But yeah, they do need financing, not for owning the aircraft. They need financing mainly like for pre-delivery bulk orders or like for management purposes to run their business, etc. But they don't necessarily need financing to own the aircraft like in the ownership model where it was required. In the aircraft management model, the operator model is very light asset based, in that the operator does not own the aircraft but just manages the aircraft for the members, for its clients. So the client already owns the aircraft and has already invested substantial amount of it. The only thing the operator is doing is managing the aircraft. So they technically require less funding than the others. So that's how you can correlate how different business models are actually causing the financing opportunities for them.
Okay, thank you. That was very helpful. And what criteria did you use to select the 7 operators that you analysed?
So when we were deciding what operators to select, we basically were looking at a few things. One is they have to be like majority leaders in the industry. Secondly, they should have distinguishing business models. And third thing, they should have a little bit of financial information available, which is so that we can compare them. And that was important for us. The operators that we selected were basically NetJets, Vista, FlexJet, Fly Exclusive, Wheels Up, AirX, and Jetlinks.
Okay, so how easy was it to obtain the information in order to build the report? Were you able to build a picture and form comparisons of working practices?
It wasn't easy to find the information. Like I said, these private aviation businesses are unlisted and they do not release the reports. So it was a bit difficult to get it. We had to look at various SEC filings. We had to go through secondary public data. We had to go to third-party data sources to kind of get proper information on this. We had to also sometimes go through the solve discrepancies against data sets and data sources. So it was quite difficult to get this data because to make it short, it's basically not publicly available. So you had to look at a lot of them. Now, we also identified few aircraft market values, which is not a public available data. And since these operators mostly go through a lot of mergers and acquisitions, they have several aircrafts within the for each operator. So we had to identify the aircrafts, get the type and composition of the aircraft and the market value of each aircraft to and we had to run a lot of correlate them to something to develop a trend analysis, which you'll find more deeper into the report.
Okay, thanks. So you used two key metrics: revenue per market value of the aircraft and EBITDA relative to debt to assess the operator performance. What did this reveal?
Okay, so let me just step back and kind of explain what revenue by aircraft market value means actually. When we started this exercise, we wanted to basically normalize the business model so we can assess different operators based on that. And the way we normalize is by using these two metrics. One is the revenue per market value. This metric was mainly to assess the capital adequacy. And then the second metric we used was EBITDA, adjusted EBITDA to the debt value. This was to kind of measure the health of the balance sheet of an operator. So these two metrics were very important. So like I said, the first metric helped us to measure the capital adequacy, which meant that how efficiently an operator is able to fund and is able to utilize the asset and turn it into revenue. High RPM would mean that, and this is mostly what we discovered through the process, is that the wholly owned operator or the operator owned model led to a higher RPM because they had to utilize the aircraft efficiently because they own the aircraft and they bear the risk of that, compared to fractional ownership where they had to kind of the hours were shared. So there was not a lot of pressure to kind of utilize the aircraft so much. So you would find higher RPMs in operator owned models. When you compare it, and then the second metric is basically to understand the financial health of an entity. So it's the financial performance and at the same time measuring the financial leverage. So how much your financial performance is helping you service your debt. That's basically adjusted EBITDA by debt ratio. So a higher ratio would indicate that you are doing well and you have the correct leverage balance and the profit or the income to sustain the debt. Whereas a lower one would mean that you will face a lot of financing risk and financial pressure. So yeah, that's the conclusion we drew from these two metrics.
Okay, and which operators stand out as good examples of long-term resilience and why?
Okay, so long-term resilience is important because this industry has gone through a lot of bankruptcies and restructuring. So it is important to understand what actually leads to better resilience in this industry. So of course, one is your financial performance, is the ability to scale, at the same time have access to capital and have negotiating power of these capital. So in our journey, in our analysis, we discovered there were three main operators that fulfilled all this criteria. It was NetJets, FlexJet and Vista. So NetJets, of course, is backed by Berkshire Hathaway, and they're the largest operator, largest fractional operator in this industry, and they have the largest fleet. So NetJets is one of the leading operators in the private aviation industry. Secondly, Vista and FlexJet, though they have significant amount of debt, but they have great EBITDA margins to sustain that debt, and at the same time they also have continuously performed and withstood all the problems in the industry, and they have access to large scale of funds as well.
Okay, so confidence in these operators has stimulated significant capital raises for Vista and FlexJet. What does this say about them as businesses and the state of the private aviation sector as a whole? What are the investors looking for?
The confidence of investors in private aviation industry is increasing for sure. And yes, Vista and FlexJet are good examples because they've recently been able to raise unsecured debt. At the same time, they have issued bonds which are oversubscribed. So which kind of enforces their power or their negotiation. Even like, for example, Vista also was able to negotiate a lower interest rate going forward. So these kind of elements add up to how private aviation is changing and how investors are more confident in this right now. So I would say yes, it's not just a luxury sector that investors are looking at. They actually think this is a profitable and an industry which will give them good returns.
And what about risk? Can you comment on the benefits of wholly owned aircraft versus the fractional ownership?
They both, I mean, it's more in depth in the report. So I don't want to go very granular. I will just keep it very high level and tell you that they both carry risk and gains, and they both impact balance sheets in a very different way. So there is no right or wrong here, but fractional, or I mean, for an operator owned model, you would see that the risk is basically for the operator because they have fully financed the aircraft and they run the financial and operational risk. But when it comes to customers, the customers who don't want ownership, the burden of ownership, it works out well for them. Whereas fractional ownership, even though they are sharing the risk with the clients will have to bear the risk of residual risk of the aircraft if the market value falls or if the market conditions change. So they have to bear that risk. Now, particularly in US, where there is regulations of tax-friendly regulations, where you can do accelerated depreciation. So some clients would actually prefer to use fractional ownership where they can benefit from the tax regulations. So it's very hard to comment on like which is the best one, because there is no best. It just depends on how well you address your client's needs. So
okay, thank you. So overall then, you say that the report bridges the transparency gap by decoding the industry's most prevalent financial models. Why is this important, and to whom? And will it be publicly available, the information?
I think yes, it's important to all the stakeholders involved. Now, when we talk about stakeholders, you would probably brief it down into three categories, right? One would be your operators. What is the benefit of this report to them? So for operators, it is important to understand that there are different types of fleet composition type which kind of result in financing. So if you had, let's say, a large younger fleet, you would probably need more financing. And you also have to look at your customers, what the customers want, and the premium position that you want to look at. So the report digs deeper into that segment as well. So it's useful for the operators to look at it. For investors, it gives them a perspective to look beyond credit ratings. It is for them to look at these ratios that we just mentioned, the RPM, the EBITDA, adjusted EBITDA by debt ratios, to kind of understand that credit rating is not the only thing to look at, but there are other things and aspects as well. How long they have lasted in the industry, how much financing they're able to raise, what's the negotiating power. And the third type of people that I would, stakeholder that I would consider important are the customers. Now, customers also need to understand that there are different business models, understand that in US, yes, it would benefit them to kind of go for a fractional ownership because of the tax benefits. But at the same time, there are also implications of the residual risk. So this report kind of helps them to understand which model works out best for them. Yes, and this report is publicly available on our website. So you can visit accaviation.com and you will find our report right there. And it's freely available.
Thank you very much for the illuminating discussion.